Ever look at the chart and just feel completely lost? You see price moving, but you have no real idea why it's moving that way. You take a trade, it reverses. You sit out of the market, and it skyrockets without you. It's frustrating, I know. And it makes you feel like other traders have a secret playbook or something that they know that you weren't given. What if I told you that that's not entirely wrong? They do have a key you might be missing, but it's not a secret indicator. It's one foundational skill that makes every single thing click in each and every single strategy that you could be trading out there, and that is understanding market structure. This is the missing context that explains why your entries fail and your stop losses get hunted, is what most would say. So in this video, I'll be giving you that key. We'll be breaking down market structure from ground up, what it is, how to use it, and how to use it to finally trade with the trend, not against it. No matter if you're trading ICT, SMC, pure market structure, EMAs, support and resistance, all of that, this is a non-negotiable framework that will clean up your trading, increase your win rate, and give you the clarity that you've been looking for. So let's dive into it. Market structure is just simply the sequence of highs and lows that price creates over time. Why is this important? Market structure gives us the overall trend of the market, helps us identify the strength or weakness between buyers and sellers, shows us exactly where liquidity sits as liquidity sits above highs and below lows, and shows us exactly or likely point where price is gonna go next. Why is market structure important? Think of market structure as your foundation. Think of it as a foundation of a house. Regardless of how good your building is after the foundation, if your foundation is bad, the house will still fall. Think of it as your strategy being like that. Regardless of whether you have good fundamentals and technicals, as long as you fail to understand market structure, basic market structure, your strategy will fail across a long given time. It may work for a week, it may work for 2 weeks, but across a long period of time, your strategy will eventually fail. That's how it works. Some strategies, they have what we call a lock point where they work for a week or two due to the right market conditions, but across the maybe let's say a year or two trading the same strategy, not understanding market structure, your strategy will fail. So going into it, we have 3 types of market structure. We have what we call a bullish market structure, we have a bearish market structure, and we have a consolidation zone. So think of okay, let's go into a bullish market structure. Think of a bullish market structure as like a staircase. Price is continuously forming high highs and high lows, meaning that you're going up a staircase. Think of it as just you're going up a staircase. You're taking 2 steps up, 1 step back. You're forming a newer high, 1 step higher, 1 step low, step higher, 1 step low, step higher, 1 step low, step higher, 1 step low. When you're climbing upstairs, you necessarily are not going higher at the time. You're taking gradual movements before you necessarily reach a peak. So think of market structure as a staircase. It's the same way, it does not change. Each and every single time you take a step, you create what we call a higher high. Higher high being the highest point before price necessarily pulls back down. And then when price pulls back down, having what we call a pullback or what others call a retracement, each and every single time price pulls down from a higher high, it forms what we call a higher low. That is the dip, the lowest point before price goes on to break the higher high. So looking at our theory on the left, our higher high is necessarily this one and our higher low being this one. So what did price do? Price came in from the higher high, which is our weak swing point. In any bullish market, your higher high is necessarily your weak swing point, or your weak swing high is what we can say. And your higher low is your strong ones, because in a bullish market, buyers are necessarily trying to protect this zone. It's just stepping in to protect this zone and this one and this one. They're trying to break above the sellers, which are resting above here, 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 and here. So that's what price does. Price comes in, forms a new high, comes back down, pulling back 1 step low, takes 2 steps high, 1 step low, 2 steps higher, 1 step low, 2 steps higher, 1 step lower. This is how bullish market necessarily works. It doesn't necessarily look like this in reality. It looks similar like this. It's more of you take one step higher, one step lower, two steps higher, you take incremental steps lower, steps lower, steps lower, and then you take two steps higher, but incrementally. You're not necessarily taking them all in one step, you're taking them little by little, and that is called our internal structure, which is everything between our swing low and our swing high. So our swing high is the highest point that price reached before it necessarily had a pullback. On our bullish market, this is our higher high, and our higher low is our swing point, which is the lowest point that price dropped before it moved back up. So swing high and swing low are necessarily turning points of the market, as we can see from our theory. The swing low is where price dropped lower before it necessarily caught more market orders to necessarily push it back higher. Think of it as more people stepped in right here to push price above this higher high, turning it weak, and then this higher high was formed. For price to necessarily change, it needs to break below this point. But what did price do? It failed, and it maintained the strength of this higher low. So bullish market, buyer stepped into the market right here and then pushed price above this higher high, which is our weak swing point. So each and every single time price fails to break below this point, we can consider this point as our weak swing, as price never really had enough momentum to break below this point. It's the on this similar on this one, as we can see. Price came in, created a high high, formed our internal market structure, which is our incremental little steps, what we can see. But price never officially broke below this point, as we can see right here. Price never came in, even though it came this close. Price never broke this low. So this is still our strong high, meaning that if price fails to break below this one, what does that mean? This is our weak swing high. So what can you do if you want to trade that? You can necessarily enter that, waiting for a change of character, taking maybe a trade right here, putting your stops below here. I don't know why it's doing that, so you can generally enter, putting your stops below there, taking a 1:2, targeting those highs. So each and every single time price does that, you can necessarily trade like that and target the weak highs, such as you can see price came in, created a new higher high as it broke price here. Price broke above, created a small step, broke our highest point, which is our swing high. Price came back for a pullback, formed our swing low, which is the lowest point before price broke back above. Never really broke below the zone. What does that tell us? That buyers are still in control of the market. So you can take entries, entering, waiting for a break of structure, retracement, entering, putting your stops below here, targeting the high. If you can trade that, you will get a nice 55%. But the problem with that is that you don't have enough confluences, and your risk to reward ratio is not proper. That's what I can say. It'll just flunk, it'll just, yeah, it's not proper. Yeah, going into a bearish market structure, think of a bearish market structure as you now climbing down the stairs. You're taking a step down, then another step down, then another step down, then another step down. That's how market order, that's how a bearish market works. We call it a downtrend, some people call it a bullish market. They're both the same thing. Just climbing down the stairs, taking two steps down, one step up, two steps down, one step up, lower step, two more steps down. It's the same thing. Each and every single time you take a step down, you create what we call a lower high. This is a rally before price fails to break above the previous high, as we can see. A lower high, what then the price do fail to break above this, a lower low which failed to break above this lower high, a lower low which price failed to break above this lower high. So these are incremental steps. We're taking two steps down, one step back, up, two steps down, one step up, two steps down. So that's how we can understand a bearish market. We're creating lower lows, which are our weak swing points, and our lower highs is what our strong swing points. So each and every single time buyers necessarily step into the market, they fail to break above the swing high. As we can see, price necessarily didn't break above that zone, and what did sellers do? Sellers stepped into the market and were targeting this lower low, broke below it, and then price had a pullback. Sellers were waiting for the market to necessarily come into a zone they want to trade in, and then what did this zone do? It failed to break above this zone, validating that this is our strong swing high and this is our weak swing low that we can target. So people would usually enter on this position targeting our weak lower low, and then it did it again, created a new lower low. What did this do? It failed to break above this lower high. So then what did price do? It continuously was targeting this low going down. In reality, it's the same as a bullish market. It doesn't look like this. It usually looks like this. So it's understanding your strong swing points and your weak swing points. As we can see from the price came in, made 2 steps down, incremental step, small step, but then this is our lowest point before price had a pullback. And then price pulled above, but it failed to break above the zone. And what did sellers do? Sellers stepped in, as we can see. Sellers stepped in, buyers tried to regain, but then they failed again. So what did they do? Sellers necessarily stepped in and broke below this low. They did the same thing. Sellers were exhausted. So what does that mean? More buyers came into the market. They tried to push the price up higher. They tried to push the price higher. They tried to push the price higher. But then when they reached the zone again, what did sellers do? Sellers stepped in to necessarily protect their positions that they entered on right here, and they push price lower each and every single time. So that's how easy understanding a bullish and a bearish market. It's just a bearish market, you're going down steps, and a bullish market, you're going up steps. Taking 2 steps up, 1 step down, 2 steps up, 1 step down, or taking 2 steps down, 1 step up. Simple as that. This is just understanding everything. So what I see most traders get wrong is that they will stay on a lower time frame. They might see a trend forming right about here, and they might be like, oops, we're in an uptrend, and then they might enter as they see price coming in here, enter targeting those highs, but they don't know the overall trend is necessarily a bearish trend. So you being able to mark out your key swing highs and key swing lows, understanding whether price is in a bullish or a bearish market, already gives you like a 10% advantage over other regular traders who do not know what they're doing. Okay, then we have what we call a consolidation zone. A consolidation zone is a zone where there's a balance between buyers and sellers in the market, meaning price is not forming higher highs and higher lows or lower highs and higher highs. Price is just stagnant. Price is not moving. There's no trend. Candlesticks are smaller, choppy, and slow. There's usually no volume. These periods happen, I would say, pre high impact news days. So watch out for that. So don't trade before NFP. Don't trade before CPI. Days before those, they're usually choppy. These are the days that most traders get caught in, because over trading, you get caught in trades like this. You might see the market, for an example, you might see the market breaking above here, forming a high, and you might be like, oops, I might want to enter on the retracement. You enter, but then your position doesn't necessarily gain that much. You might be stuck in this position for a couple of days, and your TP is not taken. So these are days that I would necessarily want to teach traders to avoid. A consolidation zone is not a good place to be trading. You can trade a consolidation if it's happening on a higher time frame. Let's say you're stuck in a weekly consolidation, you can trade it. But then if you're stuck in a 15-minute or a 5-minute consolidation zone, it's I would highly not recommend you trading, because you will lose, because there's no definitive trade. There's indecision and there's balance in the market. That's usually the worst time to be on the market. The best time to be on the market is when the market is either in a bullish market or it's either on a bearish market. So anytime price is on those two, it's very easier to trade because you can see the overall trend. But in a consolidation zone, you do not know where price will end up next, because there's usually no institutional traders, there's no banks. They're just waiting for price to either decide where it's going, or they're waiting for geopolitical news or high impact news to drop. So I would recommend for a beginner trader to not trade consolidation zones. As long as you do not understand what's going on, I highly recommend that you do not trade in the zone. Yeah, but then that's just anything. I'll show you exactly how to identify consolidation zones in the market. That's very easy. So going into what we call a change of character or a trend change. One thing I can also say is that the market changes. It's impossible for the market to stay bullish across a long period of time, and it's impossible for the market to stay bearish for a long period of time. Trend is eventually gonna change. It's impossible for the market to necessarily stay in one trend for a long period of time. So why is a change of character very important? The pros of change of character is it allows you to enter trades way earlier, and it works best when you combine it with other confluences such as liquidity, supply and demand, or anything else that you are trading. So using a change of character with anything else makes trading very much easier. As we can see on the left hand side, what does price do? We are necessarily in a bearish trend. But what is it? Price is continuously forming lower highs, lower lows, and lower highs. That's what price is doing. But then what does this zone fail to do? It fails to hold itself. So this was what we call a weak zone, since it failed to break above this high. It failed. So this one was also a weak lower low, but then what did it do? Aggressive buyers necessarily stepped in and caused the trend to change. So now this was a weak high. So each and every single time you see a change of character, it does not necessarily indicate the trend is changing. A change of characters most of the time gives off false signals unless you combine it with other confluences, like I said, supply and demand, liquidity, or whatever thing you're trading. But as we can see, the overall trend, most people would have seen the market come into the zone and think, no, price is necessarily gonna go back down. See, they would have thought, okay, price is roughly here, price is gonna come back and take the zone. But then there are some periods where price doesn't even do that. It just shoots above and breaks above that zone. So it's being able to understand that price has days like that where the overall trend will change. You can start off the day bearish and end the day bullish. You can really never know where price will be at the end of the day, but having basic understanding of the change of character helps you see it way earlier and get out of positions way earlier. So as we can see, price came in, broke above this weak swing as it failed to necessarily hold. It broke above, and what else did we see? When price broke above, this lower low was necessarily validated with price failing to break below it, showing us that the trend is now switching. But what is another thing we can use to necessarily validate that the trend is now bullish? What we call a break of structure. Price broke above this higher high, meaning what? This high was now a weak high. It was a weak high. As what did it do? This low failed. No, this low, it didn't fail. Yeah, this high failed to break below this lower low. So this then showed us that there were not necessarily enough sellers in the market to flip the market. So this is another key thing to necessarily understanding change of character, is seeing all of these little ones. As we can see, this became our strong swing. This one is also another strong swing because it broke above the zone. But then what did we see? Price broke above from the higher high, and then price came back down to the zone and broke below, creating what we call a change of character. So now this failed to hold itself, as what was it before? It came into the zone, price broke above the zone, created a higher high. This one failed to break below, showing us that it's a weak swing point. So buyers are likely to target that zone, and buyers did target that zone, which led to a break of structure. But then price came in and sellers now stepped into the market and broke below this higher low, indicating that the trend might be shifting. But we're not gonna take change of character only. We might use it with an equilibrium, which I'll be teaching you later on. We can use it the simple thing called a break of structure. We can see price necessarily came back in, validated this higher high as price failed to break above this higher high, showing us that sellers were now in demand and in control, and it creating a break of structure. It created a lower low, price came in, created a lower high, failed to break above the zone, telling us that buyers were not yet aggressive enough in the market to necessarily change the trend. So what did they do? Sellers stepped in and then created a lower high. But then what happened? Immediately after this lower high was formed, there were enough buyers in the market that were able to break above this lower high and create what we call a trend change. So buyers necessarily breaking this one and forming a trend change now shows us that the market might be shifting to a bullish market. What is another confluence we can use? Price failed to break below the zone. There were strong enough sellers in the market that broke below this lower low, but then what did buyers do? Buyers broke above this lower high, so it tells us that there were not enough sellers in the market to necessarily protect the zone. So the market was now shifting into a bullish market, as we can see from the market continuously forming higher highs and higher lows after it broke and also formed a break of structure. So if you're not sure that the trend has changed after a change of character, usually wait for a break of structure. Break of structure is one of the most important ones to validate that the trend has officially changed. If you don't see a break of structure after a change of character, usually that indicates that it's a false breakout. That means price maybe broke above to fetch liquidity and is now continuing the trend, as that's what actually happens, because the market doesn't move in a continuous pattern. There's sometimes where market can go bullish, bearish, consolidation, bullish, or it can go bullish, liquidity grab, and then continue bullish again. So it's understanding exactly if there is no change of character, there's no break of structure after a change of character, usually that's a false signal. Some people categorize it as a full candle closure, some categorize it as a wick. Whatever you categorize it as, always expect a break of structure after a change of character. So going into what we call our internal structure now, internal structure being the smaller, more detailed movement of the overall trend, meaning the micro steps of the large step we take in a staircase. Think of it, the step we take, think of the small, us lifting our leg, like a little by little by little, because each and every single time we take a step is quick, but if you slow it down, the movements we make before we necessarily make the full step. So think of an internal structure as the same way. Maybe after lifting our legs, our muscles contracting to lift our leg up. So think of internal structure as that. So now we're going to be using 4 hour as our external structure and 15 minutes as our internal structure. As we can see, price came in from the higher high, price retraced from the lower high. This was our strong swing point before price necessarily broke above this zone. We can call it our higher high. Price came in, broke above that zone, created a lower high, telling us that there were not enough sellers in the market to break below this point, showing us that buyers are still aggressive in the market, which necessarily pushed the price back high. But then what did price do after it reached its swing high? What did I say about swing high? Swing high is the highest point before a price forms a pullback. So what we usually don't see in an internal structure, you might see this as a continuous movement, as price might have moved like this, came in, formed a large move. This is what it might look like in the higher time frame, as in the 4 hour. But looking inside, we're going to be analyzing what happens exactly inside of this zone, as we're going to be taking most of our trades in there. So the overall trend is bullish. Regardless of what happens here, the overall trend is bullish. As you can see from the market, overall trend is bullish from the market, because we're continuously forming high highs and high lows. But then what happened? The internal structure formed a change of character, indicating that pullback may be happening. And then what happened afterwards? It was validated by a break of structure as price pulled in from the change of character, fetched more liquidity from a break of structure, showing us that a trend now has changed. What happened? The trend changed. It changed into a bearish. It changed into a bearish, and then what happened? The trend changed again, change of character, indicating that this might be our strong swing point, because it also failed to break below our external structure. It failed to break below. As long as this price remains up, as long as price remains above the zone, this is our strong swing point. And what did price do? It failed to break below. It came close, but it never broke below. So it was also validated by a change of character happening in that zone. And what also happened? A break of structure, forming that the pullback might be over. And what did price do? Price continued to move up, continuously forming higher highs and higher lows, higher highs and higher lows, higher highs and higher lows, after forming the overall trend right here. As we can see, the trend in between the zones was this trend was a bearish trend, internal trend. This was a bearish internal trend, as we will label it a bearish internal trend, as we can see from the market. And then what happened afterwards? It's going to load. The price formed a bullish internal trend, as we can see here. So understanding how internal trend. So understanding exactly how the higher time frame correlates to the lower time frame, what I can say is, if the higher time frame is bullish, expect the other time frames to also follow the narrative unless they're in a pullback. That's the simplest way to trade this market. Follow what the higher time frame gives you, because the higher time frame holds the higher power. If a 4-hour is bullish, unless you're trading an internal pullback, stick with the trend. What I wouldn't recommend is for beginner traders to take trades such as this one. As you can see, price broke below. You would have seen this minor pullback. It's very impossible to catch the very top of the price or the very bottom of the price. It's going to be very hard for you to catch this high, and it's going to be very hard for you to catch this high low. What I can say is, rather than trying to catch the swing points, catch price as it formed. Let's say a pullback here, you would have entered here, putting your stops below, targeting either the high or these swing points that were formed internally. That's the best way to necessarily trade market structure if you just want to trade market structure alone. There are people who've traded market structure and who are very profitable, but I wouldn't necessarily recommend it to everyone. Yeah, that's the simplest thing. I wouldn't recommend it. I would recommend you using other confluences to necessarily make you a better trader and increasing your win rate. That will be teaching you in the future, but understanding that that's the simplest way for us to understand how price moves, because 4-hour gives us the large range of how the market is moving, but the 15-minute gives us the micro steps that we'll be taking and trading. So just understanding those ones and how price moves internally can help you see exactly where to take the trade and where exactly to not take the trade. Okay, so going into structure mapping, we have two types of structure mapping. We have consecutive and we have aggressive. Consecutive structure mapping is when you only recognize the major swing highs and swing lows as the valid structure points. As we can see from our example, price came in, broke below this zone, but then as a consecutive traders, they're not counting it as this could be just a liquidity sweep or a large wick, but price never really broke and closed below the zone. Price came in, the trade is still valid as this is the overall trend. Price came in, failed to break and close below the zone, as this could be a liquidity sweep, but then price came back and at a full closure and broke below the zone. Aggressive is when you mark the internal structure swings, such as liquidity sweeps, small wicks, and all that, such as we can see from our theory on our left hand side. Price came in, broke below the zone, and we counted as a break of structure, and then price came above, broke above this zone, we counted as a break of structure, and price came back and had a full trend closure as it broke below. Why I wouldn't recommend aggressive structure mapping for beginners is you do not necessarily understand which ones are valid or not, because it gives you a lot of false signals, because price would come in close with a wick and then continue back up, or price could close with a wick and then continue back down. But I will be going into structure mapping further when we go into our market analysis, as we will be doing it on the markets now rather than just talking about it and explaining it. So yeah, let's see what the market is actually giving us. So going into our analysis of the market, showing you exactly how to map out market structure, we will be looking at the Euro USD on the daily time frame, analyzing how to necessarily predict where this market is going to be going, forecasting it by playing back on the replay. As we can see, the overall trend of the market is bullish. We can see that, not bullish, bearish, I mean, price came in creating lower lows and lower highs, lower lows and lower highs, lower highs, lower lows and lower highs, lower lows and lower highs, as we can see, by just mapping them out rather than just focusing on the ones up there. Okay, I will also focus on them, but not really now. As you can see, let me just mark them out. This is where price came in, broke, break of structure, our break of structure, our break of structure. I'll be counting this one just because it's daily. I won't be focusing on large pullbacks. I'll just count mine as like a retracement on the daily time frame, as long as it's, I'd say, I think 100 pips is forgivable, or 50 pips. So this one is a break of structure because price came in, created a lower low, formed a lower high. What did it do? Failed to break above the zone, but we won't even count the zone. But price came in, created a lower low. There are not necessarily enough buyers in the market, as you can see from the wicks. So what did price do? Price sold off and created a lower low. Price broke structure. So what did price do? Price came in. If you're not necessarily used to this, I'll be teaching this in my next upcoming video. We call this liquidity. So what did price do? Price necessarily didn't come in and close above this zone. It just came in, fetched the sell orders that were above this zone, and then what did price do? Price continued to sell off, as we can see. If you count this zone, this is where necessarily price broke structure, but due to it being a daily, I wouldn't be counting that zone. I'd usually use this one as something that you don't see. But the price do? Came in high, 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 low, high, 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 low. This one was our first change of character, high, 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 low. But I'll be showing you one that you can necessarily see. This is our change of character, showing us that price was pulling back on the aggressive side. Or unless you don't want to be aggressive, you can just use that one, showing us a change of character. Inside we can necessarily see lower low, lower high, lower low, lower high. Price broke above. It's just wicks. But then if you go into smaller time frames, you can see that price actually had a closure. Then what did price do? High, high, lower high, high, high created, but it was a liquidity sweep. Price broke structure here, a change of character. And then what did it do? Internally we can see that we do have a break of structure, which necessarily does what? Validates us. So the overall structure of the market is still bearish, as you can see. High, high, low, low, high, high. What did price do? Aggressive market. If you want to do aggressive structuring, you can see price came in, broke structure here, but necessarily did what? It was just a wick. So I wouldn't necessarily count this as a full closure. But what did price do after that? Price came in, you see this lower high, or you can even count this one depending on whether you're being aggressive or not. But let's just stay on conservative mode for now. Price came in, broke above with a full closure. Price came in, broke above that zone, as we can see. This now was our strong swing low, as we can mark it out on the market. This was our strong swing low. As what did price do? This was the slowest point that led to the overall change of the market. It's not a break of structure, it's a change of character. It's still the same thing, but this one validates, telling us that the trend switched from now a bearish to a bullish. So this is our strong and slow point. So which point are we watching for? We want to see if does price actually break above this zone, because this is the zone that price is in. Price came in for a retracement back into this zone to collect more buyers. What did sellers do? They failed to break below this area. So what does it tell us? That now buyers are necessarily in control of the market. So let's necessarily play forward and see what price does. Price continues lower. Price continues. Price right there. Just a single wick showed us what? Price did what? Price broke structure. Immediately when price broke structure, what did that tell us? Which is our strongest point now. Since this is our change of character, this now becomes our strong swing low. As this is the lowest point where price fell before it led to a change of character. This is our strong swing low. Price came in, created our lower low. Then what did it do? Broke above. So let's see what price is. So now this is our strong swing low. So let's see where price necessarily plays out. Understanding the trend, the overall trend of the market now is bullish. So let's see what the market does with that information. Price comes in, having a minor retracement. This is just enough. So what does this do? How did we see that price was now bearish? We saw by this small change of character right here. It's really simple. It's not really that hard, guys. As long as we can be able to see change of character very quick. Price came in high, broke up, failed to necessarily close above the zone, created a wick, broke below, validating that this is our change of character. Price is in an internal change of character, so waiting for a validation. Wait, right here, seeing it very early. Price did what? From the lower low, lower high, what did price do? Price failed to break above. So what that do? It created a change of character. So we were now able to identify that the market is now in a bullish trend. That means the internal pullback may be over. So we see if price targets that high, and it did, leading to a what? Break of structure, telling us that this is now our strong swing point area. As we can see from the market, this is our strong swing point. So let's play the market forward again, see what the price does. Okay, what you might not see, this is a pullback. How would I count that as a pullback? What did price do? Price from the swing high, as we can see, price from the swing high, which was weak, which failed to break below the zone. What did price do? Created lower low, lower high, lower low. No, created a lower high, high high, lower high, higher high, and then what did that high do? Came back, retraced into a zone where buyers are necessarily going to want to step in because they want to protect the zone. And what did price do? It failed to break below the zone. So what did it mean? And this is now a weak point. And what did price eventually do? Price broke above. So let's play price forward. So forgot to say, just because that zone was validated, so this is now our strong swing point. So let's play price forward. Price is having a pullback. So it's having a pullback. Price broke above. Broken close. Let's do. So let's see what price does. Consolidation. So yeah, it's the best place to play it out. What does price do? Price from a strong swing high, not even a strong swing high, a weak swing high, I mean. Price came in, price came, formed a weak swing high. This is still our strong swing point. As long as price hasn't broken below this point, we count it as our strong swing point. So what does price continue to do afterwards? It formed what we call change of character. Lower low, lower high, lower low. What did this fail to do? What failed to break above this high, validating that it's now in an internal pullback. So we mark that out as our trend change. So what was that validated by? Was also validated by a clean break of structure. Break of structure. So we're on an internal pullback, as we've seen from the market. So let's see what price continues to do afterwards. It's very early. As you can see, price formed the lower low, lower high, lower low. What did price fail to do? Price failed to break above. Price failed to break below the zone, indicating that the trend may officially be over. But you can just, if you don't want to be aggressive, you can just use this zone as if price is still trading in this zone. As long as price closes above this zone, it now is in a trend change. But understanding wicks and how they actually work, it allows us to see price change way earlier than you would if you're trading consecutively. So trading aggressively is very good, but not all the time, especially as a beginner. So price has a change of character. What does price continue to do afterwards? Let's go play price forward. Price has a break of structure. Price has a break of structure. Okay. Let's break price forward. Price is still continuing. What does price do? Takes this point. Rating at what? A break of structure. So the overall trend of the market is still a what? A bullish trend. So this one was our internal break of structure, which was first validated by this change of character. As we can see, price dropped down to this zone, formed a lower high, but then this lower low failed to break below the zone, so it indicated that buyers were stepping into the market, and they became more aggressive, the sellers. As we can see that the momentum of the market slightly became more bullish and bullish and bullish. So let's pay price out. So does price fully close or what? Price comes back in the zone. Price finally broke through. We have an internal break of structure. And then this becomes what? Our strong swing low. Okay, so let's watch price continue on. What does price do when it reaches to this point? Price is still continuing forming high highs. Okay, it's a pullback. So what happens for us to validate a pullback? Price is still pulling back. Price is a change of character. Pullback, lower low, lower high, showing us that wait, the trend might be changing. But let's just play it forward. As you can see, it's very early, predicted it due to this break of structure. What happened on this break of structure? Price failed to break above this high. It was a break of structure, but then what happened? Price didn't continue on and break above this high. But then this formed what? A clean change of character, indicating what? The price is on an internal pullback. So this becomes what? Our weak swing point. This possibly will be revisited later on. So let's play price and see what the market does. Let me just take away this zone, stopping it and creating what we call seeing the premium and discount zones. So as we can see, price had a change of character from the lower low and lower high. What did price fail to do? Right above here, price failed to continue its bearish momentum. So let's wait and see what price does actually. Does price continue on with the momentum, or does price do change of character? Perfect. This is the perfect time to explain a consolidation area. This is what we call a consolidation area. As we can see how easily it is to spot it. The consolidation area happens exactly when price doesn't create consolidation area. It happens when price doesn't create high highs and high lows and stays stagnant in an area. As we can see from price necessarily is consolidating now. It's not creating high highs, not creating low lows. As we can see, we're just stuck in the specific range. What does price do? Price eventually breaks above, but let's see what price does. Price breaks above and closes. See, we've just exited this consolidation zone, and what happened afterwards? Price necessarily targeted this weak swing high. So this led to a break of structure, indicating what to us now? That this is now our strong swing low. So now this is where price will be trading. So let's see our EQ. It is possibly our EQ upper. So using this as our weak zone, price is probably gonna take out this zone soon if the trend stays the same. So let's mark it out. Let's see what price continues to do. Price is having an internal pullback. As we can see, price formed trend change, showing to us that it's not in a bullish market anymore. Followed by what does price do afterwards? Trend change. Simple as that. As simple as that. That's how simple it is to actually understand market structure. Simple as that. This is actually what helps you become a very good trader. Just understanding the core principles of how price moves. What did price do? Didn't break above that high. What did it do? It broke below the zone. Price do break of structure, as we can see, a clean break of structure. So we're gonna play price forward. As long as price hasn't broken below the zone, we can still call it a strong zone. So price came back to the zone. Yeah, so this is where price is. So by just understanding that, I just led you through this year's price action from December till November, showing you how to actually analyze swing points, your major swing points, how to look at internal structure. That's it. By just understanding this, it gives you at least a 15% advantage over other traders. Yeah, I hope you like the video, subscribe and comment. Leave a like on what you actually want me to do, and stay tuned as I'll be releasing videos on liquidity sweeps, order blocks, advanced market structure for those who want to get very technical, who want to do multi-time frame analysis, and I'm gonna break down my whole trading strategy, including cumulative delta, a new indicator that came out on TradingView that gives you a very big advantage compared to what any other person trades. So yeah, hope you like and subscribe, and see you on the next one.